Hi, welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment, or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
I asked Sentio to sponsor this podcast because I use the research platform almost every day, as you can see on the screen. For equity analysts, it's in many respects the ideal tool. If I didn't have a professional platform, I would need several different software systems. Sentio saves me a lot of time and ensures my research can be done in one place. I like it because first, the data is reliable and it aggregates all content. Second, it's easy to use and much more intuitive than other platforms. Third, it has features I have never seen in other systems. My favourite is the ability to go into a 10K and extract the history for a particular data table. If I want to see the trend in a parameter, and I often do this, I snap my fingers without having to dig through multiple 10Ks. It's much faster and easier. But most important is the price. There's a huge price advantage over other systems. If you're a smaller fund or even a larger fund equipping analysts, Sentio is definitely worth looking at. Visit sentio.com, that's sentio.com/BTBS for Behind the Balance Sheet for more details.
In this episode, I'm joined by Chris Pavese, the President and CIO of Broyhill Asset Management. He's a seriously thoughtful investor. He trained as an architect, and we talk about how investing straddles both left and right brain thinking. Broyhill is based in the south of the US in the Blue Ridge Mountains, a beautiful part of the country. We talk about the north-south divide in Europe and the US. Warning, if you're English, you might not like some of my comments from the perspective of a Scot. But we had a really interesting discussion about whether the advantages of being located outside the bustling environment of a New York or London will continue to confer the same benefits in the days of Zoom, or where there might be an even bigger advantage. Broyhill is a book club, and we talk about the benefits and indeed the joy of reading widely. Chris explains his investment philosophy and why he has fewer than 20 stocks in his portfolio. He explains why the only research he buys is from a short seller, even though he doesn't short. For me, this is a really enjoyable discussion. I hope you enjoy it as much as I did. Chris, hi, welcome to the show. Thanks so much for coming on. I really appreciate it.
Thanks for having me, Steve.
Oh, no, not at all. So look, at one point you had planned to be an architect, and you even did some time in a Frank Lloyd Wright building. So how come you ended up as an investor?
Yeah, it's a good question, and one I've talked about a bit more recently. And I think several years ago, I'd actually written a piece comparing, the architectural process with the investment process. Obviously, very different roles, but I think there's a lot of similarities. The short version is, I was 2 years into a 5-year architecture program, undergraduate program at Penn State. Was loving it, although that program, I don't know if you remember any architecture students in an undergrad or graduate program, but we basically lived at the studio. I mean, I remember spending one stretch 36 to 48 hours or more straight in the studio, during finals, ordering food, sleeping under the desk, etc. So like investing, it's a business and a career that I think you have to actually deeply love and be passionate about to succeed. And I did, but like I said, 2 years in, I came to the realization that I could graduate with an undergrad in architecture, go back to school for another 2 years for a master's, and then 7 years, have both an undergraduate and graduate degree in architecture. Or I could switch over, do 4 years in business/finance, develop somewhat of a business understanding, and then go back for 3 years for a master's in architecture and have 2 degrees in that same 7 years. Life just kind of gets in the way of plans occasionally. And it was, this was the late 90s, markets were booming. I've always kind of straddled, I guess, both what you'd call like left brain and right brain thinking, right? There's a good piece of me that enjoys the sort of creative element of design, both architectural and investing design and process, as well as sort of the more scientific and mathematical process. And I just decided to make the jump over what seemed like a more academic and financial and mathematical career, but I think investing requires just as much creativity as any architectural career would require. It's just applied maybe slightly differently.
Yeah, it's funny you should say that, because I've always described myself as creative, and my wife kind of laughs, but I think investing and analysis is a creative endeavor. I mean, I don't know that it's as creative as architecture, because I remember I did a project, a loft apartment in London on the river with a very famous London-based architect. He might not be famous in the United States, but a guy called Seth Stein. And I remember when he came up with the drawings, it was like, how could he visualize this from an empty box? And I remember asking him, what will this look like from when I'm sitting here? How will that? And he drew all these little drawings. And when I actually moved in, I looked at the drawings, and it was exactly the way he had envisaged it. So I think, architecture is, I think investing is creative, but architecture, I think, is a creative at the next level. But listen, you moved to Broyhill, and you think you went there as CIO after 5 years as a PM at JP Morgan and 1 year as an associate before that. So you must have joined there when you were quite young. And I was wondering, what was it that they saw in you that enabled them to trust you when you were relatively young with relatively limited experience? Because that's family wealth, right? It's quite a brave and I mean, for you, quite a heavy burden, I would imagine.
Yeah, and not to mention a little bit of a culture shock moving from Midtown Manhattan to what I lovingly refer to as Mayberry, North Carolina. That reference may not carry a whole lot of weight in across the pond, but just think of a sleepy, what people would call a one stoplight type of town in the middle of at the base of the foothills of the Appalachian Mountains in North Carolina. So it was a bit of a transition. I've asked myself that, Steve, a number of questions. Why a conservative, long, family with this rich Southern history would be comfortable with a young Italian kid that grew up in New Jersey and worked in New York. And I'm still reminded that I'm the damn Yankee in the office, which again may not translate across the pond, but for clarification, right? A Yankee is a northerner that moves into the South. A damn Yankee is one that doesn't move back. And so I'm reminded that on a regular basis. It was just, I think we just hit it off. I started my career at JPM in '98, left in '05. So I guess that's about 7 years at JPM. At the time, Morgan was this boutique investment bank with a storied history. At the time I joined, I think JPM had maybe 10, 12,000 employees and maybe a dozen portfolio managers at the bank. Shortly after I joined, there was the merger with Chase. Shortly after that, there was a merger with Bank One that, of course, brought Jamie Dimon into the fold. And so the organization changed dramatically. I'm not sure what the employee count is today, but it's somewhere in the hundreds of thousands, not not anywhere near 10,000. Morgan at the time had a phenomenal investment management training program. Learned a ton those first few years, and this was, as you know, a much different world than it is today. I think, late 90s, early 2000s, most of the learning at any organization you were at, came from came internally, right? It was there wasn't this, we had no blogs, we had no Substack. You read other research publications, right? But the amount of knowledge distributed today and that we have access today is just really unparalleled. So back then I was fortunate to learn from a strong organization, but felt like I'd soaked up everything I could possibly soak up at the bank, and was ready to try something new and expand my horizons. And there was an opportunity. To do so with the Broyhill family, and we're almost 20 years later today, and I'm still here and still enjoying the ride just as much as I did day one.
Well, that's fantastic. You'll be amused to hear that JP Morgan bought Chase shortly after Chase bought a small Scottish merchant bank, originally Scottish, based in London, Robert Fleming. And I was at Robert Fleming, and Chase took us over, and it was really good fun. I mean, I was in the Chase offices in New York the day the deal actually closed, and when JP Morgan took over, there was all this maneuvering, because of course JP Morgan had a research department. This was a sell side bank. I was in Robert Fleming. We had a sell side bank. Chase had a couple of analysts. So there's all this jockeying, as there is when you're putting two businesses together. And originally it seemed that I was going to be binned, and I managed to get myself in a position where they decided not to bin me. And then the week before, they decided to fire not just me, but every director of Chase stroke Robert Fleming. And it was very fun. I mean, the whole experience was very funny. But the funniest thing was that there was one guy that they didn't fire, and he was based in Edinburgh, because what they'd done was they decided who they were going to fire by looking at the floor plan. And he didn't have a desk in London, and they didn't realize that he worked from the Edinburgh office. They didn't even realize that there were any others in the Edinburgh office. So that, the well-executed plans of a smooth machine like JP Morgan, I'm sure it'd be much better under Jamie Dimon, but don't hold your breath. And I should say, although I'm based in London, the people that listen to this podcast, they're astonishingly, I mean, much to my amazement, the podcast has been downloaded in over 100 countries. So, but the explanation about the north and south of the United States is always helpful, because the north and south of every country are remarkably different, particularly in Europe and particularly in the UK, because I'm from Scotland, which is a superior country, but I live in England with the English. But I mean, the thing about America is it's kind of the other way around, isn't it? Because the people in the south are nicer than the people in the north, whereas in the UK, the people in Scotland are nicer than the people in England. That's right? Yeah.
I'm gonna bite my tongue there, and I'm gonna plead the fifth on that comment, Steve. But yeah.
All the sort of marketing type blurb that you produce, Broyhill is always talking about the Blue Ridge Mountains. I mean, I've actually been, I'm well traveled in the United States, funnily enough. So I've actually been to the Blue Ridge Mountains. I spent a very happy weekend in Gatlinburg, Tennessee, which I guess isn't far from you. But I mean, why is it good to be an investor in that sort of environment? Is it just because you're far away from the noise of New York and the bustle and the short-termism and the hustle?
Yeah, I think that's a great question, and one that I've thought about a lot since joining Broyhill, and more as I've matured, as you said. When I was late 20s when I moved, I was in my late 20s when I made the move down here. Looking back, I don't know that I could do my job as well as we do if I was in New York 24/7. I love going back. I plug in to New York and other large cities and financial centers regularly throughout the year. But it's just so nice and so valuable to be able to unplug as well, decompress, and really just kind of truly think independently about sort of what you took in, what you learned, or what you thought you might have learned, and process that information. I feel like in New York and probably many other cities, it's just the focus is on the next week, the next quarter, the next month, and everyone there. The noise is deafening. And it's repetitive, and it's hard to run into people that don't have the same view or aren't sort of beating the same drums all the time. And so I think being away from that, being removed from that intentionally, for us anyway, right? I mean, every investor is different. Every investor, there's a lot of ways to make money in the market. I think a lot of this business is finding out what works for you and what works for your investors and sticking with it. And this worked for us, right? For other firms, being close to that information and being that tuned in on a daily basis or even minute to minute is important. For us, as a distraction.
Do you think?
And I think.
Sorry, I was just going to ask, but do you think that's changed post-COVID? Do you think your relative advantage is eroded a bit as more people work from home and there's more distance, or do you think it would still be?
Yeah, that's a good question. I think a lot of it is just right. It's also distance geographically, right? But it's also distance mentally, and it's just sort of a different psychological and analytical framework and behavioral framework. And some people are just programmed different than others, and we just tend to prefer. We just tend to do better sort of out here on our own. We'll see how the whole COVID work from home thing plays out over time. I wouldn't be surprised if in a few years, right, and particularly as the economy changes and potentially employers gain more, get some leverage back over employees, we start seeing people coming back into the cities and coming back into the office, and really firms demanding people back in the office. But we'll see.
No, so I mean, it's interesting. We get that here, if you speak to investors in Scotland, not that there's that many of them left, but they feel, when I was on the sell side, when I started in the industry, there was a different environment when you went to Edinburgh than there was, in London. So I think there is a distance. Although, honestly, I wonder why, because if you're in London or if you're in New York, you've got the advantage that they've got all these companies coming through, for example. Whereas if you're in North Carolina, I don't know, companies coming through New York aren't necessarily going to come and see you. Now that may be there in a Zoom-based world, that's less of a disadvantage, I imagine. But there's also why would that not be an advantage? If you're in New York and you can see that company next week and you don't have to make the effort of phoning them, you can actually be in the room with them. That's a lot better than not having that opportunity. But I know what you mean, because people do get caught up in the short term, and there's an awful lot of mingling. And do you think part of it is the fact that investors are talking to each other more and they're in the same room and they get caught up in the same things? Do you think it's easier to distance yourself if you're physically distant?
I think absolutely. But I also think the point you made in terms of access is an important one, right? And that's clearly a trade-off we're consciously making and comfortable making. But it's also, I feel like you can still get that by plugging in when you need to, right? You may miss, there's no shortage of ideas, right? We don't have a problem coming up with ideas to track down and hunt down, right? It's really the bigger problem is creating the right filter. And so, right, you don't have to meet with or necessarily should meet with everyone coming through all the time, because it's I kind of look at that as almost like email, right? If you're if you're spending all day in your inbox, right, you're managing other people's priorities rather than your own. And I guess I could see the same thing as if you're in New York, right? If your inbox is constantly filled up, literally and figuratively, with people wanting to come in and meetings and people coming in to see you, that's different than being selective and handpicking. Okay, like I need to spend time here. Let's go out and spend a week visiting these companies, right, or head out to this conference or this or that, and spend a day talking to these businesses, these companies, these investors, and sort of doing it on our schedule as opposed to theirs.
Yeah, I mean, I suppose, my background is I was a global investor. So, sitting in London when you had, a lot of companies from overseas coming through, it was quite helpful because it meant you didn't need to travel as much going out, and you just get a flavor for what was going on in different parts of the world. And of course, there's no pressure on you to take a meeting. You know that company's in town. If you want to see them, you can see them. If you don't want to see them, you can't. But it's an interesting issue about that distance and that separation, and the extent to which it does enable you to take a more balanced, longer term, easier view. I don't have a strong feeling about it, and I suspect that the fact that you can now have a Zoom call with a company makes it it makes everything a lot easier. You don't need to go to New York or London or Hong Kong or wherever. Well, not Hong Kong, of course. Now I was reading your 2021 letter, and you write really, really well. And I thought it was very funny because you were talking about monkeys throwing darts. And you wrote, a dart throwing chimp will occasionally hit a bullseye, but as much as he might like to think so, that doesn't make him the next Warren Buffett of dart throwing, whoever that is. Now, I should interject. I know you're American, so you may not be aware that there is a World Darts Championship, which is held like half an hour away from me. Peter Wright is the current champion. I had to look that up. But you go on to say, we see a lot of dart throwing chimps in this market, as the majority of investors managing capital today have yet to experience a protracted downturn. So what I want to ask you is, did the meme stocks, the bull market geniuses, the Twitterati talking about Zoom being a great company, did that get to you a little bit? Because it kind of got to me a little bit, because I was thinking, man, these people do not know what they're doing, and they're people think they're geniuses. And when's it all going? I know obviously nobody likes a bear market. I'm kind of pleased that the bubble has been burst. But I mean, how do you feel about this?
Yeah, I mean, I'd be lying if I said it didn't get to us, right? I mean, and it wasn't. I mean, the last few years, well, at least up until 2021, were kind of a frenzy accelerated version of what we had been experiencing for the last several years, right? I mean, value investing, conservative investing has underperformed growth or more aggressive styles of investing for the better part or more of the last decade. So it's been a long slug for investors like us. Like I was going to say, like many investors today, but the reality is there aren't. I would say the majority of investors today probably haven't lived through a variety of different cycles, let's say. And what we saw today was very similar to what we saw in the late 90s, in our opinion. And I think the folks that got caught up on this are probably the folks that didn't live through that. It's one thing to read about history; it's another to actually experience it, right? Like you can spend a lot of time, you can spend as much time as you want in school learning about finance and learning about how to value a security. But until you actually buy those shares and live through, those shares being cut in half, the behavioral aspect of investing is it's a completely different game, and it's something that just you learn over time. There's so many great quotes from the late 90s. I would say, and to put this in perspective, I think it was like in our 17 or 18 letter, we had a long excerpt where we were quoting Julian Robertson's final letter to investors while he was shutting down Tiger Global, right? So like we were making these comparisons to the 90s for the last several years, which also is not unusual, right? I think it was, what was it? Was it 96 when Greenspan came out and coined the term irrational exuberance, right? So that was, I mean, he was 4 or 5 years ahead of the top. You had another, right? And really the last two were the most spectacular in terms of gains for NASDAQ and Internet, which is exactly what we saw here. The last 1 or 2 were the most spectacular for the meme stocks and for the Twitterati. That's a great term, by the way, Steve. So it was frustrating. It was a little bit easier for us to stomach, as we were still able to make money during those markets. There was a lot of what we call statistical value investors that had just sort of stuck to buying low PE, low priced book stocks that some of which lost a lot of assets, both in terms of performance and clients over those years leading up to the market top. We want to be in a position to, in an ideal scenario, to make a little bit of money in many market environments, right? Whether we're in a complete, risk on, throw the baby out with the bathwater, or just kind of throw darts at the board and anything works. We want to be able to make a little bit money in those types of markets, and we want to be able to make money in markets like we've seen over the last 6 months. And it's a little bit easier to sort of stick with it if you're making money. Although like you said, it's never fun making less when, than everybody else around you, especially when you feel and are confident that everyone else around you, or a good portion of the folks around you getting rich, are doing so for the wrong reasons.
Yeah, I think there's sort of an intellectual dishonesty sometimes about people in these markets, and I don't know. I mean, I think every serious investor wonders.
Yeah.
I had a conversation by email with somebody I know that I'm actually invested in his fund through a structure, and he was writing about his terrible relative performance last year, and this is a brilliant investor, and he was kind of beating himself up because he hadn't beaten the market. And I said, if you'd beaten the market, I'd be wanting to take my money out. And
right.
And of course now
right.
that these people are all recovering relative, although obviously when the stock market goes down, it's more painful. I mean, I loved it in the letter you mentioned that Cathie Wood still manages more money than David Einhorn. I mean, how long will that carry on? Because David Einhorn seems to me like these are you picked exactly the right example. David was in London about a month ago, and I went along. Somebody kindly invited me to the presentation he was doing, and I went along and chatted to him. He's an incredibly smart, incredibly thoughtful investor, and it's kind of bizarre to me that he has to fly to London to look for investors, and Cathie Wood just has to tweet and people give her money. I mean, it seems unjust, right?
Yeah, I mean, I just sent something around to the team yesterday. I mean, the Arc Innovation Etf, which is sort of their flagship product, which is still north of 9 billion in assets today. They've seen inflows for 8 straight days today. So so I want to say it's it was north of 600 million in inflows in the last week or two. So the fact that despite being down, I'm not even sure how much at this point, investors are still plowing money into that fund, and really that's just a proxy, right, for just the entire speculative corner of the market. I think is a big warning sign, right? That we're nowhere near to the washout we need, right? Like even 2008. Well, of course, 2020 COVID, the bear market lasted all of a few weeks. I mean, it was one of the most severe declines, certainly that we've ever seen or experienced, but even in history, right? It was, I mean, just the how quickly the markets dropped. I mean, it was just relentless day after day after day, and they were big declines, but the trip back was just as fast, if not faster. So you really didn't wash out any of the sort of speculative excesses that we had in the market up to this point. And in fact, we just amplified them over the next 12 to 18 months. '08 was, it took a little bit longer, right? But it was still, it was still a very sharp rebound, and really it was a very sharp downfall. I mean, we were kind of, treading water up to the Lehman event, right? But beyond that, and then after that, it was straight down from end of September through March, which is, not, in hindsight, a great length of time for sentiment to really shift and for sort of that new generation of investors to kind of step in. Contrast that to what the markets went through in the '70s or even in the early 2000s, right? I mean, it was a grueling bear market. It was death by 1,000 cuts from 2000 to 2002, and so by the time the day traders back in '98, '99. Maybe after the first 6 months, first 12 months, like they were probably still doing what investors are doing today, and that looking at every down drop, every down day as an opportunity to step in and throw more money at it. And every time the market started rallying, they were worrying about missing it and plow back in. And that happened for 3 years until investors said, "Okay, this isn't working anymore. I give up. I want nothing to do with the market." And that set the stage, right, for one of the greatest bull markets in history over the next really 20 years. It was briefly interrupted in '08, but outside of that, like that 20-year stretch was one of the best in terms of annual CAGR over the long term for the market. I think you need to see that type of washout to set a foundation for growth going forward, and I think that's just going to take time. I mean, you mentioned the Twitter crowd. You can see it right in the commentary on Twitter, and the fact that folks are they've not changed their tune. They've not given up. The stocks that we're trading, stocks are cheap at 10 times sales, but that's because they traded at 50 to 80 times sales 6 to 12 months ago. 10 times sales historically has not been it's probably been more of a top than a bottom. And the fact that we're looking at it today as a potential, indicator that stocks are getting cheap, and every company different. Using a multiple of sales isn't the best. I don't think is the best metric. It's a shortcut in a lot of ways, but different businesses deserve. There may be some that deserve to trade at 10 times sales, but not the quantity that are trading there today or were trading there 6 months ago.
I can remember being asked to be the cornerstone investor in a new IPO, a very interesting company when I was at the hedge funds. And I asked them what, and this isn't recently, this is a long time ago. And they told me the valuation. And I said, well, that would be 10 times sales. And they said, yeah. I said, if you're thinking about 5 times sales, I might look at it, but at 10 times sales, forget it. And of course, it came to the stock market, went up, and then fell by 80%. But it's interesting that you make this point, because this the calibration, people are still sort of anchored on that high, and they haven't yet really re-examined what the valuation should be. So they're not, they're not looking back over a long enough horizon. They're just looking back over a very short term and not really thinking about what valuation might be in the longer term. And obviously, we're at a juncture where we don't know where interest rates are going to top out. So there's a certain amount of sympathy when interest rates were zero as to people paying up a lot for assets, because where else do you invest? And I guess we get to that point again, but I wonder if we have to find some more real levels. I don't like to talk too much about current prices and current market levels, because I think that makes the podcast have a very short time value. And I kind of like to do sort of more longer term thinking. But I just was curious, because back in August of 2020, you were quoted as saying markets could be trading at half these levels in a year or two. And S&P then was about where it is now. If you were interviewed now, would you still say that?
If you looked at, well, let me preface this saying, Steve, the stock market is one thing, right? A market of stocks is another, right? And so we may or may not have views which may or may not be accurate on where the overall market should trade. Regardless of where the overall market should trade, right? Our job is to find good investments and mispriced assets. But could we see the market trade down materially from here, even after the decline we've seen? I mean, the reality is the overall market hasn't seen much of a decline.
Yeah.
The biggest names in the market have just started to crack, right? Like Q1 of this year. Well, really, the most egregious pockets of the market really peaked, early to midway through last year, right? So they've really been declining for 12 months now. But the overall market was held up by the largest names in the market, which accounted for nearly 30% of the S&P at the peak, which is also a record high, and also what you see near cyclical bull market peaks, right? You see an increased concentration driven by increased flows to passive, which drive more concentration, which drive more flows, et cetera. That works on the way down as well, right? When those flows start reversing, those same names that drove markets higher can drive the markets lower. You think about names like Google, Facebook, Amazon. We'll take Amazon out for a second, but historically, at least as long as they've been around, people haven't really even been able to imagine those advertising business slowing, let alone actually declining year over year. But I mean, if you think about both Google and Facebook, right? They make up the large majority of the online advertising market. Two, right, that market has grown significantly as a share of the overall advertising market. And guess what? Advertising is a cyclical business. When companies go through tough times, they cut advertising, and past cycles, right? Like those, that secular driver moving from offline to online was enough to sort of keep those companies continuing to grow. At some point, they become a large enough piece of the pie. When the pie shrinks, they shrink. And so, could you see a shift in sentiment where the multiples on those business go from, where they are today to something substantially lower? I was going over some material earlier this week, and it's hard to believe, but it wasn't too long ago where like stocks like Microsoft and Apple, right, were trading at single-digit multiples of earnings. They were trading north of 30 times, right? Both companies, up until a few months ago. I'm not sure exactly where they stand today. I would argue those businesses haven't changed much, right? It's just kind of what people have been willing to pay for those businesses have changed. And so could we get back to a situation where, right, the sentiment shifts again? Apple takes a wrong step somewhere, they have a bust of a product, and all of a sudden people assume that they've lost its mojo, and they're never going to create another iPhone, and game's over. And it's tough to sort of, again, step out of sort of consensus and kind of look at contrary factuals, right? Like what could possibly happen.
Apple's a good example, actually, because you think about, my perception is that we're going into much more difficult economic times. And if we're going into much more difficult economic times, well, luxury products, luxury and luxury for you and me. Are we going to be rushing out to buy the newest iPhone? I wonder. Seems slightly bizarre to me. Nobody's ever said that, Tim Cook's not Steve Jobs. And, I know he's done a brilliant job, but it seems that nobody can say anything bad about any of these companies. And there's a very unbalanced debate, I think, is my observation. But let's look a bit longer term. I've been doing a few podcasts this year, just talking to a lot of macro type commentators and talking about, okay, so we've had 40 years of falling interest rates. And we know that that's not going to happen for the next 40 years. Obviously, from our starting point, it can't do. Obviously, we've got all the issues of inflation and everything else. So I was saying, well, you know, what's worked in the last 40 years probably isn't going to work any longer. And so you need to think a bit differently. And I'd like to get your perspective on that, partly as a stock picker and partly because you also do things beyond stocks, right? So I've got three sort of issues about this. The first one is about, you've talked about value beating growth by 16% per annum, I think it was, for 5 years after the tech boom. Is this, you know, what we should expect over the next few years? And you also talked in your letter about your portfolio having a bit more rotation of late. One of the things I wonder is, are we going to have to be a bit more nimble in the next few years? So say the market is the same level in 10 years' time, which I think is, you know, wouldn't be an unreasonable assumption.
Yeah.
Does that mean that we're going to have to, you know, find this special situation, watch it go up, then find something else? And I mean, are we going to have to play through a different playbook?
So that's an interesting question. So a couple things there, Steve. And one, I think, let me back up to your last question too. I mean, that's a good differentiator, right? So like, if you look at something like the Schiller PE, right, earnings on 10-year trailing basis, I mean, we've come down from nosebleed levels to, I mean, I think we're still near 30 times trailing 10-year earnings, right? Versus, you know, long-term average, I don't know, call it 16, 17, 18, if you want to give, you know, market credit for a rising trend. So, you know, and as you know, right, like markets are like rubber bands, and this works for markets overall, but also, you know, also individual stocks where, you know, you move from one extreme to another. You rarely go from one extreme back to average, right? Average is created by periods above average and periods below average. And so if you're trading, you know, at a record extreme above average, you know, you're probably not going to stop at trend or long-term average. But that doesn't necessarily mean, and this just quick, circling back to your last question before moving on to this one, that markets need to be cut in half today or over the next year. Like you said, they could be flat. You know, we could just go nowhere for a while with a lot of volatility. And that's another way where you get back to average. That also, to your point, right, is a much different environment that most investors have seen over the last 10 years and for most of the last 20 years. You know, one of the questions we've asked ourselves numerous times over that period was, you know, and you've seen a generation of investors grow up under the understanding that if you buy a good company, you don't have to worry about ever selling it. You can own it forever because good companies only go up in prices, right? And there's no too high a price, right, for a great business. That was really just more a relic of the market we were in, right? Like, and people have learned that lesson over and over again through history, and we've forgotten it over and over again through history. And to your point, yeah, I think understanding the market regime and the market environment that we're in should inform how you shape and construct portfolios. You know, we were slow to learn, you know, an important lesson over the years, and still learning an important lesson where, like, I think you need to differentiate up front when you own an asset, what type of asset it is, right? So we owned, I'll give you an example of a couple of mistakes we've made in the past to illustrate this, but, you know, we owned both Microsoft and Apple at single-digit multiples of earnings and sold both for phenomenal gains a year or two later and gave up, you know, multiples of those phenomenal gains over the next several years, right? That was probably one of the most costly mistakes we've made. And that mistake was simply just, as opposed to saying, okay, this business is starting to get expensive. It was dirt cheap. Now it's probably fairly priced. We're going to punt this and buy something else that's cheap, that's not as great of a business. You know, in hindsight, right, the lesson to learn there was you want to give those businesses more room to run. You can't own them at any price, right? But you want to give them more room to run, as opposed to other businesses that are just, you know, wildly underpriced, but perhaps lesser quality businesses, right? There you probably need to sell those businesses as they approach fair value, as opposed to holding on and letting that fair value compound for you over time. And so I would say it depends on how you think about and how you construct the portfolio as to what that means for what the portfolio looks like and what would might be a sideways market, right? If you've got if you're true to your stripes and you're buying businesses below fair value and trimming or selling them as they approach fair value or get more and more expensive, right? In theory, as markets, like even in a sideways market, let's say we go through a period of a year or two where markets are rallying and getting more expensive, and most of the underlying stocks in those markets are rallying and getting more expensive, then we should be selling those as they get more expensive, which in theory, right, will be increasing our cash position and lowering our equity exposure. And it works on the flip side too, right? Then as markets fall back to normal or cheap levels, we should see more opportunities to buy even cheaper stocks, and we should be putting some of that cash to work. Over the last 10 years, holding cash has, we've been screamed at, yelled at, frowned upon for holding cash. But I think like cash in this type of environment proves its worth very quickly, both in terms of cushioning some of the volatility that we've seen this year and are likely to continue to see in the future. But it also just provides you with that element, in a market that's not trending one way or another. Being able to sell something without having a mandate that forces you to put that cash right back to work just because you sold something. I think there's a lot of value in that type of approach, and that's frankly how we've always approached the markets.
Well, what would be the maximum of cash you would hold, or does it depend on the market?
It depends on the market and the mandate. But I mean, we've run as high as 40% over the last 10 years. We're not that high today, but it's also that's a function of both top down and bottom up opportunity set. So today, for example, I would say risks are higher than they've been in a very long time. But there's also enough interesting, potentially uncorrelated opportunities in the market, or less correlated market opportunities in the market, where we would rather hold things like that than hold cash.
I mean, there are a lot of optically cheap stocks around. The one thing that slightly puzzles me at this juncture is we've got over half of economists now forecasting a recession. I don't know what planet the other half are on, but economists are always slightly bizarre. But the analysts don't seem to bother cutting their numbers. I mean, I haven't looked this week, but last time I looked, I couldn't see any, the S&P 500 estimate just carried on going up. And I'm thinking, there's some disconnect here. Can you make sense of that?
No, although, right, I would say economists may be ahead of the game this cycle, and analysts are probably where they usually are, right? I'd say the economists are the exception, not necessarily the analysts. Earnings estimates are normally the last to kind of revise down after the companies tell them they need to come down, or after they start missing.
It's pretty unusual for economists to be, for over half of them to be forecasting a recession. Recessions aren't usually as well telegraphed. It's not usually as obvious as it is now. I mean, maybe I'll be wrong. I hope I'll be wrong, but it seems to me, they're all indicators, all signposts are pointing to a very tough environment. And what the economists who aren't forecasting a recession, I don't quite know what their assumptions would be. But, if analysts, you would imagine, would be looking at this and saying, well, things are not going to be as easy as they have been. And of course, we're coming from historically very high margins and returns in capital. So you imagine that there's quite a significant amount of downside in earnings. And of course, particularly in S&P 500, there's quite a lot of leverage. So, there's a kind of a very unpleasant cocktail around. I mean, I think there's still some good, cheap stocks, but it just puzzles me slightly that the overall appearance of the market is cheaper than it actually is.
Yeah, I think we would agree that earnings are probably the next shoe to drop, right? And so investors looking at the market now and saying, and sort of quoting it on current earnings or either trailing or forward earnings, it's the P is corrected, the E hasn't yet.
No.
I mean, the other thing that's interesting, and again, right, like it seems to us that we're headed towards recession. There's enough unknowns and uncertainty and risks on the horizon and risks we're currently dealing with that it's hard to imagine that we don't get there. And we can debate whether it's just a slowdown or the depths of the recession or how big of an issue it is. Normally, one of the things that's interesting is, so at least in the US, you look at like the Atlanta Fed has the GDP now forecast, which right now is sort of bordering on zero for the current quarter and is sort of fluctuating negative to positive. And so, folks are looking at that. I mean, normally by the time everyone agrees that we're heading for a recession, we've already been in one for several months.
Yeah.
And I mean, it doesn't feel like that in the U.S. Consumers are still spending money that we gave out, for the last year or two. But with housing prices where they are, with what it's cost filling up gas tanks and put food on the table, it's just hard to see how the average consumer, really anywhere in the world, can continue spending like they've been spending.
No, I mean, for the average person, it must be getting increasingly tough. And, this is a terrible thing about inflation because it's a tax on the poor. You and I can manage and cope with the additional cost of filling up our cars. But it's the average person who probably needs to drive to work and who will find it much tougher, which I think is the sort of terrible, sad thing. And of course, many people just don't really understand what inflation is. I mean, I've always felt, although I know we've been in a disinflationary environment, I've always felt that my personal basket of consumption was subject to quite significant inflation. And that's before any of this started. So, I think, my personal consumption is over 10% inflation right now, and I don't see any prospect of it tailing off. And we're beginning to see this being reflected in labor demands in the UK, although I think that's not quite as strong in the United States, but maybe we'll just be worse hit. You talk about international beating the US. I just wondered, how does your allocation look now? How many stocks would you normally hold in your portfolio? And how many would be US? How many would be international? And are you being pushed overseas?
I think that was, as usual, more a function of the opportunity set we've been seeing and where we're seeing value in markets. Historically, we've run with 10 to 20 names in the portfolio. We're at the high end of that today. And again, that's just, that's more personal preference than any scientific calculation. I've learned over the years that, when I start approaching that 10 line item, I lose sleep because I feel like we're over concentrated. When I start getting north of 20 or too far north of 20, I start losing sleep because I feel like I don't have my arms around the portfolio as tight as I should be. And so that's kind of been the sweet spot for us. And that ranges too with the types of names that we own, right? So we try to leverage the work we're doing to get the most bang of it. We're a small team, that's by design. I don't want to manage a large team or a large organization. I like
like being involved and in the weeds on every position, but that means, right, we're limited in what we can look at. So we need to make sure that filter is working robustly. But that means we'll own names. So we've got, we have $2 stores in the industry. We have two tobacco companies. We've got 3 airports. You can think of those each as one position because they're very obviously very closely related, and it's the work is the same across the businesses. International today probably represents roughly 40% of the portfolio of our equity portfolio. And really that's Steve, that's more a function of mispricing than any top-down view of the world. I can tell you, a lot of those names happen to be in Latin America. I can tell you that we didn't sit down and come up with a wildly bullish economic scenario for Argentina, Mexico, Brazil, or just LATAM in general. But we were finding, a very high number of very cheap, very good businesses in those markets. And that's perhaps because nobody else could come up with a good reason, a wildly bullish economic scenario for those markets. But that doesn't mean that there's not good businesses that can continue to perform well, even in those geographies.
Oh, I'm sure that's right. I mean, the Argentina is an interesting country. Not a huge amount of opportunity to invest, though. It's difficult to find. I always find it difficult to place to calibrate. I mean, obviously more stuff in Brazil, but more problems. Mexico, I think, is very interesting. I was just at lunchtime. I went to a presentation of a new startup investment. I do a little bit of startup investing, and it's a manufactured product, and they're looking to penetrate the US market. And I said, so where are you going to make this? And they said, Mexico. And, it's kind of an obvious thing, especially when the dollar is so strong, that it gives a massive, massive tailwind for that sort of economy. You've written quite a bit about how you operate as a team, and that's quite unusual because most teams think they've got some sort of secret sauce and they kind of want to keep it secret. I've never met anybody who had any secret sauce. I mean, I always ask people about how they do things, and I've never, nobody ever told me. I mean, maybe they have secret sauce and they don't tell you, but now I've a training business and I go into clients, and you do get a sense, particularly if you're doing a big program, you do get a sense of how they operate. And most firms have, they've got different ideas about how they do, but they basically do the same thing, but they don't like to talk about it. But one of the things you talk about is having bull, bear, and central cases and multiple scenarios for every investment, and each team member having their own ideas about the value. How does that, I mean, what do you do? You all come in and you say, I think it's worth 3, and I think it's worth 4, and I think it's worth 5. Oh, let's just take 4. I mean, how do you discuss it, and how do you form the team opinion?
Yeah, I mean, like you said, Steve, there's certainly no secret sauce, and it's something that we're constantly refining and trying to improve and trying to learn from as many sources and resources as we can. Anecdotally, and I'll go off on a slight tangent here. I had a really interesting conversation, and I guess this was pre-COVID. Was sitting down with a firm that made all of their decisions. Everyone at the firm, there were 4 investors at the firm, and they were all portfolio managers. There were no analysts. They all had the same title. And anyone's idea, they all discussed every idea together as a team, but normally there was one person leading the effort on each name. But the discussion was a team, but the decision was never made as a team, right? So, and I thought this was really interesting in that it was not decision by a committee. So if you presented something and everyone on the team disagreed with you, it still went in the portfolio. If you felt strongly about it, it was sized differently, right? If you're the only one supporting the name, but it's one portfolio, and there's three, four investment members on there, and they debate and they talk through it. There were also no presentations, which I thought was very interesting, because they didn't do formal pitches, because they felt that by doing that, the best pitch or the best presenter made it into the portfolio, not necessarily the best idea. And I think there's so much value in recognizing that, right? I mean, it is just, you go to an investment conference, and I'm going to one in a few weeks, and you hear some phenomenal presentations of horrible ideas, and you hear awful presentations of phenomenal ideas, and it's very hard to separate the two when you're sitting there. But what I thought was most interesting from this firm in particular was that when they looked at the performance of when they ran an attribution on the fund over time, the best performers over time were those names where they had most disagreement and still put the name in the book. Right. And if you think about it, that makes sense, right? If you all agree that it's a great investment, everyone probably else does as well outside of the firm, and it's probably priced as such. But if it's an investment that is, drenched in controversy, it's got a higher likelihood of being mispriced. And so, I think it was very smart to make sure that those names made it into the portfolio, even if everyone disagreed. I wouldn't say that we go that far, right? So I take input from as many sources as possible, both internal and outside the firm. But ultimately, right, the decision in terms of when, where, and how much we invest rests on my shoulders. So right or wrong, I take the credit on both sides of those trades. But I do think it's important to think through various potential outcomes, and not just say this is what we think the stock is worth, right? Because there's just too many variables. We try hard to isolate what are the 3 or 4 things that really matter here and that are going to drive value, because there's hundreds of things and hundreds of questions that you need to ask, but really there's only 3 or 4 that matter. And looking at the 100 can take your eye off of the 3 or 4 that, if you miss one of those, can be very costly. But just tackling that as a team, talking through it, making sure that we flush out any disagreements, so that we at least understand where everyone's coming from and understand the counterpoint of view, I think is tremendously important. We talk to, while we enjoy being kind of apart from consensus and outside of major financial centers, I enjoy talking to other investors, and both to kind of poke holes in our ideas and to generate new ideas. We pay for one piece of external research. And even though we don't short stocks, the only research we pay for is a firm that provides short recommendations, because I just think there's tremendous value in understanding kind of that perspective, on different industries, whether or not we're involved. It may be something we're looking at, or it may be something related to a portfolio company, or best case scenario, they issue a short recommendation on something that we own. And so we can sort of have an active dialogue and understand, where those differences of opinion lie. And what I found over time is more often, assuming we're just not outright wrong, or they're not outright wrong, more often than not, it's just a difference in time horizon there. Right. If you're shorting stocks, your time horizon is by definition, I think, much shorter than someone that's with a longer term horizon, that's owning companies that want to compound over value, because time works in your favor. Whereas if you're short a stock, you're on the clock.
Yeah, I mean, it's interesting. The last podcast we did was with Dan McCrum, who was the FT journalist who exposed the Wirecard fraud in Germany, and I interviewed sell-side research boutique who'd issued 40-something research reports on Wirecard every one a sell over a period of 6 or 7 years. And of course, when you're a sell side boutique and people are paying you to give them short input, you just have to keep, and you believe something's a fraud, you have to keep up the program of sell notes. But when you're actually short, it's impossible. And I used to, when I was at the hedge funds, forensic accounting shorts was something that I approached with great trepidation. And I've even not shorted things that I knew were fraudulent or likely to go bust, simply because they were so shorted that, and if you think something's slightly fraudulent, the chance of it coming up with good results is actually exceptionally high, perversely. And then you get the short squeeze, and it's just too painful. I just got beaten up too many times.
I mean, maybe the best example of that I can remember, Steve, is you mentioned David Einhorn earlier at the start of our show, and his book, Fooling Some of the People All the Time, on his battles with Allied Capital, right? That began, I think, in the late 90s, maybe early 2000s, right? And Allied didn't ultimately file for bankruptcy until the financial crisis and after 2008. And David was short that entire time. I mean, that's just that was a phenomenal book. Just kind of to get your arms around the extent of what it takes to kind of do that level of diligence and stick with a position, and how difficult it is, knowing when every bone in your body tells you you're right and the market's just telling you you're wrong for 10 years.
What I found remarkable about that book was that none of the sell side listened to him. Well, can you imagine, you're a sell side analyst and David Einhorn says he's short of this stock. I mean, I would say, I wonder if I could, come round and talk to one of your analysts for half an hour. Would they spare the time? And they just didn't listen. I mean, I asked them about it. They just didn't listen. People not interested in the numbers. People like stories. And this is, I think this is very, very true. One of the things in our forensic accounting course, we look at how many people read the financial statements, and you'd be amazed. I mean, the evidence is that just reading the financial statements will give you an information advantage. Now, that sounds like ridiculous, that of course, every professional investor reads the 10K, but I can guarantee you that they don't. It is the most amazing thing. But talking about reading, so you started the Broyhill Book Club, which is how I first found you, I think. Why did you do that? Tell us about what was the motivation, and what's it been like having a book club as a professional investor?
Yeah, so let me give you a bit of context first there. I was never a big reader. I don't think I picked up well, let me clarify. I don't think I voluntarily picked up my first book to read until long after I was already in the middle of my career post undergraduate studies. It just was not something I ever really enjoyed. We talked a bit starting off, Steve, about what it was like leaving JPM and moving south, working for a small family office. That was the most exciting thing about that journey for me, starting out, while I was still in my 20s, was having to kind of create and find my mentors, and all of those came in books, right? Like a mentorship doesn't have to necessarily be in person, and it's a little bit difficult to be in person when you're in Lenore, North Carolina, finding a mentor in the industry. And so I began reading everything and anything I could get my hands on, and started discovering the world of investing outside of JP Morgan, which formed a lot of my thinking to this day. It wasn't until several years after that. I mean, this is, well, I guess the book club we started doing about 5 years ago. So, it was 10 or so years after first joining. I'm not sure what the catalyst was, but I remember one December just deciding that I was going to read a book a week the following year. and that's really how it started. And then at the end of the year, I thought to myself, you know what, maybe I should kind of do something to kind of put this list together and share it. And that was how it started. And then once you did it one year, I couldn't necessarily stop doing it. And just it's just tremendously, it just brings me a lot of joy. The process, and I normally do it. We changed it a few years ago. We used to do it at the beginning of the year as an annual book club, for selfish reasons, just given everything else that's going on at the beginning of the year between earnings reports and holidays and putting together an annual letter. That was probably not the best time to try to put together a list of books as comprehensive as we did. So we moved it a few years ago to a summer reading list, which works great because I get to spend, if we've got a summer vacation somewhere in June or July, I spend that week mornings before the family gets up, just kind of reflecting and looking back on everything I've read and sort of put notes together and then just hand it off to the team to get it out the door. But it's a phenomenal experience. If nothing else, it's been a great way to meet new people. I'm not sure that I knew that, Steve, that's how you came across us, but maybe you wouldn't be surprised, but we've met a lot of folks that have reached out to us in one form, in some form or fashion after reading one of those book clubs.
All right, and it's interesting. So you take notes and you do it like a job, like you do write a review and take it quite seriously.
It depends on the book, right? I think there's different types of reading for different types of book, depending upon what you want to get out of it. There was a year where I focused on speed reading, and sort of, was 100% focused on how fast I could get through things and was timing myself and sort of measuring productivity, and it just wasn't enjoyable, right? And it's nice to be able to speed read an earnings transcript rather than listening to an hour or 2 hour call, being able to literally 5-10 minutes glance through and take away the main points. But there's books that are just enjoyable that you want to read over time and just kind of soak up and sit with, and there's others that are not. And then there's books where there are just filled with lessons that either I want to share with the team, either about investing or kind of team performance, culture, et cetera, that I'm taking notes in the margin more diligently and sort of categorizing and sharing my thinking, as I'm doing it. And then, I've got those to go back to when we publish the full list at the end of the year.
And you're reading physical books then, not a Kindle?
It's a variety, right? So my strong preference, all else being equal, is I love a hardcover in my hands. I like being able to scribble in the margins. I like being able to underline. I like being able to sort of create a index on the back cover or inside cover of the book. That said, Kindle for note taking can't be beat. So I've got a we can geek out on this forever, Steve, and maybe this will be another call in the future, but like I've got all of my Kindle highlights export to a database where I keep all of my notes on books I'm reading, as well as all the research we're doing on the team, et cetera. And so all that is sort of automatically exported and categorized and indexed. And so Kindle's really nice for that. But if it's a book I really enjoy, I'll buy a hard copy as well. And then Audible is just, I can't listen to books or podcasts for that matter, unless I'm traveling for some reason. And so books on Audible and podcasts are relegated to things I'm listening to in the car.
Oh yeah, I mean, I found that I don't really like the idea of listening to a book, and I prefer to listen to podcasts. So I've not tried an Audible, although funnily enough, when I was asked, would I record the Audible version of my own book? And I thought, oh, don't be stupid, it'll just take forever. Just get somebody to do it. And I hadn't realized the process is that they get people to audition by reading the preface. And I mean, they were god awful. I had to listen. I had to choose, and they were all awful, except one person was actually quite cheerful. And so I said, well, let's just have the cheerful person. They've got an American accent. So I thought, if I read it, then nobody's going to understand it. So I thought, well, let's get this person. And of course, when they actually did the recording, they weren't quite as cheerful. I think, it's, obviously, I'm more palatable one page than 200, but which is perfectly understandable.
Yeah.
So tell me, one thing that I always ask people to recommend is a book that they love or a book that they would give to somebody who is wanting to become an investor. I mean, you've probably got a few recommendations, but what give us a couple that you've really liked.
Yeah, so that's a tough one, right? Because I'm an over-gifter when it comes to book. I mean, I would say just about every other thing I've read, somebody comes to mind and I send them a copy of that book. It's just, it's another thing that brings me joy. So it's tough for me to make a blanket recommendation without knowing who that, personally who that recommendation is for.
The younger you going to North Carolina, what would you pick up in the airport?
So younger me, let me give you
I'll get a couple.
Let me give you a couple. One of my favorites of all time, and it's I think the best historic example of blending creative thinking with scientific processes and design, would be Walter Isaacson's Leonardo da Vinci biography. And I would also say I would read anything Isaacson has ever written. Is phenomenal and would be near the top of my list. But his account of sort of Da Vinci's life and accomplishments and sort of tying that together with the value of having what we would call a childlike curiosity or a beginner's mind is just a phenomenal. It just brought me so much joy. I would probably have started reading along those lines, a little bit more science for perspective as well then. So I would read anything by or about Richard Feynman, for both the knowledge base and humor that comes with that category. And I would put E.O. Wilson in that bucket as well. He's written some phenomenal stuff. Younger me probably needed to learn a little bit more about decision making and human psychology. So some recent favorites there. Obvious one, Daniel Kahneman, anything he's written, Thinking Fast and Slow, kind of being the primary source there. The book Super Forecasting, Phil Tetlock and company, was phenomenal. And then you could pair that with Annie Duke's Thinking in Bets. And then maybe slightly more off the run. Not sure if you're familiar with the work of Peter Bevlin, Steve, but Seeking Wisdom, I think, was the first one he wrote. A Few Lessons from Sherlock Holmes is another. And I would also add any Sherlock Holmes related or original stories are some of my favorites too. And there's phenomenal linkages there to let's see, sort of investigative work to the type of investigative work required for investors. And then the other one that Bevlin did was A Few Lessons for Investors and Managers from Buffett. And then maybe, particularly today, I'd say, how we started this conversation, I'd say history is more important, and understanding history is probably more important than it's ever been. So some of my favorites there, Kinderberg's Manias, Panics, and Crashes, Charles Mackay's Extraordinary Popular Delusions and Madness of Crowds. And I've got to mention, since we just chatted last week, Ed Chancellor's Devil Take the Hindmost. I don't know if you know Ed, but he's another, I guess, somewhere in your backyard, Steve. He may be a good addition for this show at some point. Ed's, I think, one of the sharpest financial historians in the business, and wrote also wrote, in addition to his work in financial history, what I would call two of the most underappreciated books on investing that I would put on my top 10 for any investor. And I guess these are the only actual finance books, dedicated financial books I'm mentioning here. The first was Capital Account, which you're probably, I think you had one of the guys from Marathon on, or one or more guys from Marathon on the show, haven't you?
Yeah. So Edward Chancellor is a friend of Russell Napier, who's a friend of mine. And Russell, I did a podcast with Russell and Jeremy Hosking, who was one of the Marathon partners. And then they split up and he set up on his own Hosking company. So I did the podcast 2 or 3 podcasts ago with Russell and Jeremy, because they're old friends. And we were trying to do the capital cycle in an age of financial repression, because obviously, in an inflationary environment, it's going to become much more important. And Russell was sick of the sight of me, because that week we recorded the podcast on the Thursday, we had a drink on the Friday, and on the Saturday I went to the lecture that Edward gives on Russell's course. Russell does a course called The History of Financial Markets, and it's now an online version, but he does it in person. So I'm going for the full course in October, but he said, oh, you should come and listen to Edward explain the capital cycle, because obviously we just done the podcast. And then on the Monday, I took him to see David Einhorn. So we had quite a few days together. But yeah, those books were magnificent. And I mean, funnily enough, I know the people that are still at Marathon. I also know them, and they're very, very smart investors. And very long.
I think those books today are just, could not have, you could not pick a better time to read those books, just given the similarities. Like the first book, which Ed reminded me that he had sent me a copy of Capital Account, which I think now sells for like $1,000 because it's out of print, maybe like a decade ago. So he was quick to remind me of that, and point out that if he was smart, he would have been dripping those into the market right over talking about Capital Account and managing supply side. But Capital Account, as you know, covers the period, right? Marathon's letters from the late 90s to the early 2000s, which I think are a phenomenal analog for what we're seeing right now. And so, if you could get your hands on a copy of that, I would highly recommend it. The next best thing would be Capital Returns, I think it's called, which is the second version of that book, which covers the period from leading up to and after the housing crisis. So you've got like 2 financial bubbles building and bursting, right? Like you've got data and anecdotes on them in real time in both those books that are just, I think they're phenomenal.
Yeah, it's an interesting thing that people haven't paid more attention to. I mean, I thought that it was really widely known and understood, and I've written about it a couple of times, and people said, "Oh man, that's fascinating." I said, "Well, I just assumed that everybody had read that stuff and then realized it's a lot easier to forecast the supply than demand." So everybody spends all their time thinking, and I mean, I guess this comes more naturally to me because my background, when I started, I was a transport analyst on the south side. So in the transport sector, it's all about how much supply is coming. And all you need, that's what you watch. And when there's too much supply. But obviously it's very applicable to lots and lots of industries. And it's strange that people don't pay more attention to it, because there's no question that it's a very, very effective approach. Listen, thank you for that. I don't think we've had as many book recommendations as that. I'm looking forward to the web developer managing to fit them all on the page, because we've got a new website, and the technology of doing the pages is much more difficult than it used to be. So she's going to be thanking you. You're lucky that you're in that little town in North Carolina, I read about it. I thought it was a very cruel comment on Google. Somebody who lived there, I looked it up. It said 18,000 people, low cost of living is great, mostly friendly people. I thought everybody in the South was friendly, mostly friendly people, and good opportunities for work. There isn't much going on after 9 p.m. or on Sunday, which is obviously good for if you want to read, right? But listen, I'm looking forward to my next visit to the Blue Ridge Mountains. We had a very good time last time. I've been making all these new wonderful friends in the United States, and lots of people in your neck of the woods. So I'm not going to make it this summer because we've got a trip in the west of the country, but hopefully another time. I really, really appreciate your taking the time and sharing your experience, and you've got a very, very unusual role because there aren't many people that think 20 stocks is too many, and I'm completely with you because I think people overvalue having diversification, and once you get 15 stocks, you've got all the diversification you need, really. And thank you so much for your time, and I look forward. Hopefully we'll manage to get a drink in person. You should come to the UK because there's loads of cheap stocks here.
Well, I may take you up on that, Steve, and we'd love to host you whenever you get back out to the East Coast here in the States, so please let me know.
Thank you so much.
All right, thank you.
That really got me thinking about whether it's better to be based at the heart of the action in London or New York, or whether distance gives you a better perspective. Obviously, there are lots of advantages of being in the countryside, and Zoom is now a great leveler. You can easily attend conferences, and many company meetings take place over Zoom. For me, London's still the greatest city in the world, and I can't see myself moving. And after listening to Chris's extensive book suggestions, it also got me thinking about whether I'm reading widely enough. I hope you enjoyed this episode as much as I did. Please let me know your feedback. Thanks for listening. I'm Steve Clapham, and that was the Behind the Balance Sheet podcast. If you enjoyed it, please don't forget to rate the podcast on Spotify, Apple Podcasts, or whichever platform you use. And don't forget to sign up on our website, behindthebalancesheet.com, to get our newsletter and access to our club where we post free training, podcast commentary, and much more. Thanks for joining us.